The first 100 days of a new US president is often regarded as key, none more so than the new incumbent who appears quite divisive. Can Donald Trump really push through a politically digestible plan to add 25 million jobs, send US growth to 4% and add fiscal stimulus without stirring uncontrollable inflation and upsetting the global trade balance? Kamil Chedid is investment strategist at BlackRock. He joins us now with some more on this. It's a really fascinating period we're entering here, and indeed the first weekend has been taken up much with press attacks as much as anything by Donald Trump. What are the markets pricing in?
So if you look at the markets since Trump was elected in November, it's quite interesting because a lot has already been priced in terms of the promises that he has made with regards to additional spending on infrastructure and with regards to some of the trade policies that he's been talking about. So if you look at US equities, they've continued to rally since President Trump was elected. They're up more than 5% since November. And if you look at the segments of the stock market in the US that have rallied the most, then you land in areas like basic resources, like infrastructure stocks, so really areas of the market that are playing on the Trumponomics theme. Then looking at fixed income, 10-year yields have backed up, so we've seen what we call the reflation theme, where treasury yields are going up on anticipation of higher inflation. And in fact, inflation numbers that have been reported so far in January have been pointing to higher inflation. And so a lot of the moves on what President Trump will do or may not do have already started to play out in the market.
So what does this do then to the Fed's expectation of 3 interest rate rises in 2017?
So let me tell you where our expectations are firstly. So we expect 2 to 3 interest rate rises, which is fairly similar to the Fed's expectations. The dots chart that the FOMC members point to is 3 hikes in 2017. There are 2 things to look at here. The upside potential to that is whether President Trump sticks to his promise around the job numbers that you introduced with. That will have inflationary effects that may go beyond what is being priced in right now. So there is a small tail risk, but I don't attach a huge probability to that. A small tail risk where the Fed would have to hike more than is currently priced in by the market and that they are indicating. But on the flip side, there is also the notion that, well, President Trump has promised a lot of things. If you look at his cabinet appointments, a lot of them seem to be contradictory in terms of the appointments' views on certain economic matters. So the verdict is still out on how much can actually be passed through once we progress through the first 100 days. And there is also a chance that if markets get disappointed with the amount of spending and stimulus that actually is actioned, you could see an environment where the Fed holds on a bit longer.
How do you see this rolling out across the rest of the world? How does it affect us here in the UK, the Bank of England, European Central Bank and the Eurozone, the Bank of Japan and the Japanese economy, China and so forth? We've heard a lot about the trade issues potentially there. How do you see the risks playing out?
Yeah, so I think there's some clear winners and losers from the dynamic that we are seeing playing out from the White House. I'll start with Japan. Japan has already been seeing some positive effects. The strength in the dollar that we have seen in November and after November, after the US elections, has translated to weakness in the yen. And in the Japanese market, a weaker yen usually correlates with higher equities. So from the perspective of an international investor, there's actually a lot of opportunity in Japanese equities if you're hedging that risk to the yen. Equities are going higher, and that can continue to play out if the stronger dollar continues on the back of Trump policies. In terms of other parts of the world, so with Europe, similarly, on the currency side, the euro has been dropping. A weaker euro tends to benefit export-oriented stocks in the Eurozone. And European equities are still quite under-owned. They have cheap valuations. So with this euro tailwind, there's a big if, which is the many elections that we have in Europe lined up for us this year, France, Netherlands, Germany, to name a few. if those political events play out with the tail risk not materializing, then that tailwind could start to benefit Europe. As for the UK, I think the UK has more to worry about in terms of the path of the negotiations with its EU partners, now that we are approaching the self-imposed March deadline of triggering Article 50 from the government. So I would look to how those negotiations go in terms of implications for the UK, more than what's coming out of the US. But obviously there's a lot to look out for in terms of the meeting between Prime Minister May and President Trump this Friday. She is one of the first international leaders to meet him. So it will be interesting to see if anything tangible comes out of that.
And they'll be talking about trade, of course. And we've heard a lot about the concerns about trade between China and Russia and the US. Mm-hmm. Do you see that as playing out, or do you think they'll sidestep that and manage a good relationship?
Yes, I mean, China and Mexico, those are the assets that could get impacted the most in the most direct fashion from Trump. We've looked at some trade numbers, and China actually exports to the US 4 times more than it imports. So China has more at stake than the US does, which is why it's not very surprising to hear the Chinese president at Davos last week defending globalization and defending the importance of countries to, yes, put their national interest first, but also take into consideration the global forces of trade. So there's a lot at stake here with China-US relations, but let's wait and see whether Trump as a president ends up being a little more within boundaries than he was as a candidate.
Yeah. One final thing has got to be oil. Trump has come to the White House, pump more oil. And of course, the way that OPEC recently has been cutting production, we've heard evidence about this last week. OPEC seems to be doing all that it's promised in cutting production, sending prices up. That plays into Trump's lap, doesn't it? Because that puts a good price under the price of crude, which helps the shale producers.
Yeah. So also to add to that, which I agree with, shale producers in the US, the technology is such that if the rigs are already there, opening and closing the tap is fairly an easy job relative to, say, in the Middle East and oil supply there. So it makes it quite elastic in that when the price goes up, there's a huge incentive for the shale producers to put more oil on the market, hence capping the price. So it's an interesting dynamic which could keep a ceiling on the oil price as it goes up.
Karim, we've got to leave it there, but thanks for joining us.
Thank you.
Kamil Chedid is investment strategist at BlackRock, joining us there to take a look at what could happen in the first 100 days of President Trump.